Pull up your credit card statement right now and you'll probably see it as a single number. What you owe or what you paid off. What you won't see is how many different ways that one piece of plastic just made money for someone else. Most people assume credit card companies make their money the obvious way. Interest. You carry a balance, they charge you for it. End of story. That's part of it. But it's a small part of a much bigger machine, one that makes money off you whether you pay interest or not, whether you use the card at all in a given month or not, and even, in a strange way, whether you pay your bill perfectly on time every single time. To understand how that machine works, you have to follow the money through 4 separate channels, because a credit card company is not one business. It's at least 4 businesses wearing the same piece of plastic. The first channel is the one almost nobody thinks about, because it never appears on your statement at all. It's called the interchange fee, and it happens every single time you swipe, tap, or type in your card number. Here's how it works. When you buy something for $100, the merchant doesn't actually receive $100. The store's bank, called the acquirer, pays that money to your card's issuing bank, but keeps back a small percentage first, typically somewhere between 1% and 3%, depending on the card and the type of business. That slice is the interchange fee, and it flows to the bank that issued your card, with a smaller cut going to the card network itself, like Visa or MasterCard. You never see this transaction. The merchant absorbs it as a cost of doing business, then quietly folds it into the price of everything they sell, which means you're paying it too, just invisibly, spread across every purchase you make anywhere, even if you've never carried a credit card balance in your life. This is also why some merchants add a small surcharge for card payments or offer a discount for cash. They're trying to claw back a fee that, by design, most customers never notice. On the roughly $3.6 trillion in credit card purchases made in the United States in a recent year alone, that sliver of a percentage adds up to tens of billions of dollars collected before a single customer has paid a cent in interest. The second channel is the one people assume is the whole story: interest. And it really is the biggest single piece of the puzzle. The Federal Reserve has found that the interest charged on revolving balances accounts for roughly 80% of a typical card's profitability. But the mechanism behind that number is sharper than most people realize. Credit card interest doesn't work like a simple annual rate quietly ticking away in the background. It compounds daily. Every day you carry a balance, that day's interest gets added onto what you owe, and the next day's interest is calculated on that new, slightly larger number. On a $10,000 balance at a 22% rate, daily compounding alone adds roughly $189 a month to what you owe before you've made a single payment. And the system is built with a very specific trigger. As long as you pay your full statement balance every month, most cards charge you nothing in interest at all. The moment you carry even a small balance past that deadline, the grace period disappears, and every new purchase starts generating interest immediately from the day you made it. That one missed full payment can be the difference between a card that costs you nothing and a loan at 20% or more. The third channel is fees, the one part of the business that actually shows up in plain sight on your statement, and yet somehow still adds up to billions of dollars a year across the industry. Annual fees, which can run from nothing at all to several $100s for premium travel cards. Late fees, charged when a payment misses its deadline. Cash advance fees, charged at a higher rate than ordinary purchases the moment you use your card to withdraw cash. Balance transfer fees and foreign transaction fees, each a small percentage collected on specific kinds of use. None of these looks dramatic on its own. Together, in a recent industry-wide accounting, fee income alone topped tens of billions of dollars in a single year, on top of everything collected through interest and interchange. Not every issuer leans on these channels equally. Mass market banks, the ones issuing cards to customers with strong credit, still draw most of their profit from interest because their cardholders are approved for larger balances and better rates. Subprime issuers, which specialize in cardholders with weaker credit, typically flip that balance, leaning far more heavily on fees because their customers are more likely to trigger a late payment or a penalty rate than to responsibly carry a large, steadily interest-generating balance for years. The fourth channel is the strangest one because it looks like the credit card company giving money away, and in a sense, it is, but not without getting something bigger back. This is the reward system. Cashback, points, airline miles, all of it funded largely out of the interchange fees collected from merchants. When your card offers 2% cashback, that money is essentially a slice of the roughly 2% interchange fee the merchant already paid, handed back to you as an incentive to keep swiping. The purpose of a rewards program isn't generosity, it's volume. The more you use the card, the more interchange income it generates, and the rewards exist specifically to make sure you reach for that card instead of a competitor's. Put all four channels together and a strange picture emerges. A credit card company doesn't need you to fall behind on payments to make money from you, though it certainly profits more when you do. It makes money the moment you swipe, through a fee you'll never see. It makes more money if you carry a balance, through interest that compounds daily and is engineered to be easy to trigger and hard to escape. It makes money on the fees attached to almost every kind of unusual card use. And when it hands you cash back or airline miles, it's really just returning a portion of money it already collected from someone else, in exchange for making sure you keep generating more of it. None of this makes the credit card itself a trap. Used carefully, paid off in full, held without unnecessary fees, chosen deliberately, a credit card can genuinely cost its holder almost nothing while still being extremely profitable for the bank behind it, because the merchant fee alone is enough to turn a profit on a responsible cardholder. The business isn't built on catching people out. It's built on volume, on habit, and on a financial system so quiet that most of its biggest transactions never appear on the one piece of paper you actually read. That's the real business model behind the piece of plastic in your wallet. Not a single fee and not a single interest rate. 4 overlapping revenue streams running at the same time on every single purchase you make. Most of them completely invisible, all of them adding up to one of the most profitable industries in modern banking. The next time you tap your card without a second thought, remember that somewhere in that half-second transaction, at least one of those 4 channels has already quietly opened. If stories like this one stay with you, the ones where the facts run out before the answers do, subscribe, because that's exactly what this channel is built around. And if you've got a theory, a detail we missed, or a case you think deserves this kind of deep dive, drop it in the comments. Some of the best stories on this channel started as a suggestion from someone watching,